What's going on, everyone? This is David Green, your host of the Bigger Pockets Real Estate Podcast, joined today with my partner and the broker of the One Brokerage, Christian Batchelder, and we have got a Mortgage Monday market update, also known as a MU show for you today. We're going to be getting into what Jerome Powell is doing, the holding pattern that the economy is in, and why rates went up in spite of that. All that and more in today's show. And stick around all the way to the end because we are going to get into our thoughts on how the economy can be struggling even if the housing market looks solid. Don't be fooled by what you see on the outside. Dig in and see what's really going on in the fundamentals of today's show. Christian, welcome to Mortgage Monday. How are you today?
Pretty good.
As 2023 is coming to a close, we've got an update for you on what Jerome Powell has been up to, as well as some information about housing inventory and how it is affecting the market as a whole.
But before we get into that, you can find investor-friendly agents in your market for free at biggerpockets.com/agent match. Okay, now back to Mortgage Mondays.
All right, let's jump into this. So first off, Jerome Powell has said that the economy seems to be doing well, so he doesn't see a need to raise interest rates again. A lot of that has to do with the unemployment numbers that we're looking at. Can you just share a little bit of your understanding of what's going on in Powell's head?
Yeah, let me say Powell's head as well as how the market interprets it, because those are two very different things, okay? And we've said this on a couple of extra episodes, but we really wanted to get one that was just dedicated to this. What it's really important for you guys to understand is that mortgage rates are not one-to-one followers of what the Fed does. It has an impact, but more so than what just happens the day of the announcement. So for instance, as David shared, Powell decided to pause interest rates temporarily through next month. And we're recording this, mid-October here of 2023. Rates actually increased. You would think a pause in interest rates is a overall good thing, right? He's not going to increase them, but mortgage rates have been up the last 4 days. The reason being is actually not what got the news headline. It's the thoughts that Jerome Powell was thinking and what he shared for the future, right? And he does sound like he's sticking to his higher for longer mentality. I've said a couple times on Mortgage Mondays, I know David's reiterated as well on a number of things that we've hosted. We anticipate rates not dropping for another 12 months, right? We anticipate these rates to stay relatively stable through 2024. So everybody who's buying and getting pressure saled by loan officers saying, just buy the property, it doesn't matter, refinance in 12 months. That may not be an option, right? So you got to make sure you target real estate that works now. And in the event a refinance takes place, that's awesome. Take advantage of it. But mortgage rates follow future news, not present news, okay? So when Jerome Powell says, I'm pausing interest rates for now, but I do not anticipate lowering them, we're going to stick higher for longer. Lenders who are lending money right now care more about what his projection is over the next 12 months instead of what he does today, okay? And they price based off that news. So if a lot of you follow mortgage rates, you'd see even though good news, theoretically good news from the Fed came out today, the last 6 days we've had interest rate increases and pretty significant ones as well. And it's because it's in reaction to what's going to happen, not what is happening.
Okay, so Jerome Powell has said, hey, the economy looks good. I don't plan on raising the prime rate anymore. And then mortgage rates went up. Sum up why that happened.
Yeah, it's all about, like I said, he even though he's not raising them, that means he's not decreasing them either. He's staying stable, and lenders already had future drops priced in. And everything's on percentages. Like if you guys ever follow like the projections, it's almost like a gambler's forum. Like, JP Morgan says there's a 76% likelihood the Fed's going to increase the federal funds rate. It's super funny. They just slap these like seemingly arbitrary percentages on them. It's like an over-under on a football game, right? Like, the Eagles are going to win over-under by 3 points or whatever, right? These financial institutions do the same thing on Jerome Powell's decisions. Okay, so if we had a 50% chance that Jerome Powell was going to decrease rates in the next 12 months, and he just said, my goal is to have it higher for longer, we're going to stay stable, that 50% now drops way down to like a 10%. Like he's not going to drop rates unless something shakes his confidence. So the lenders that already had that 50% price drop built in now have to remove it. And the result of that is an increase in interest rates offered on mortgages, even though there was no movement in the federal funds rate.
All right, let's get into what's going on in the real estate market as a whole. Now, here's something that I think a lot of people are just under erroneous assumptions. The assumption is if rates go up, the price of houses will go down. And people have been very confused that rates are going up, but the prices of houses are not going down. Instead, what's happening is less houses are actually trading hands. we are seeing a significant reduction in the velocity of money as well as the velocity of deed transfers. You just don't see as many houses selling, as many people buying, but that is causing the supply to stay where it's at. So the prices aren't actually coming down because we still have a small supply, which can be very frustrating because the whole idea was if they raise rates, it would bring the price of housing down and make housing affordable. And it's actually becoming even more unaffordable, even though the prices are not going up. Now, Christian, you found an article that I believe is in MBS Highway that is explaining how many months of inventory we have in the housing market. What'd you see there?
Yeah, it's pretty incredible just to hear these numbers. And while we've been pretty consistent at this mark for a while, inventory levels are at 3.4 months right now. Now, breaking that into layman's terms, that means if no house hit the market, no houses were listed for the next 3.4 months, there would be 0 properties for sale in America. That means we have 3.4 months of the average buying power on the market currently. And this gets up as high as like 12, 15 months of inventory sometimes in like really buyer's markets where there's just an oversupply of houses. We have 3 months of inventory, guys. And think about that. An escrow is at minimum usually 30 days. So if you take 1 month of escrow out, we really only have 2 months because that's including houses that are in pending, contract right now and they're going to close within 30 days. So if no house was listed right now, we really only have 2.4 months, right? If you remove the 30 days. So it's like, what happens if sellers just don't sell? Like there's no more houses in 3 months, right? Now, obviously there's not going to be no new houses on the market, but just this is a historically low inventory. I think that's what David's really focusing on here. It's historical that there's this few properties listed for this amount of people who want to buy, even though rates and prices are high. There's a reason why it's not impacting most markets in America, and it's supply.
And this is the irony of when you try to use interest rates to control the economy. They're actually creating a bit of a feeding frenzy because as inventory is shrinking, the people who need to buy a house and they can afford to buy a house are fighting to get them, which is keeping prices high or even going up in a lot of markets, even though the actual inventory itself is decreasing. Now, I feel this information is relevant because even though the price of homes are not coming down, that does not mean the economy is doing well. There is a huge chunk of our economy that is dependent on housing transactions taking place. It's not just real estate agents and commissions. It is loan officers and commissions. It is title officers. It is escrow officers, home stagers, contractors, property managers, the home photographers, the stagers of these properties, processors that work for the companies. There's a lot of people that only get paid when a house changes hands. The people doing the home inspection, the pest inspection, the roofers who come in to make the repairs, the moving companies that help you get your stuff from one house to the next, the landscaping companies that you hire to come and get everything going. If we can say that transactions are down to 30% of where they were, that also means that all of these other industries are theoretically making 30% as much money as they were before, which is going to have a massive impact on our economy because these people all need to pay their mortgages. They need to pay their rent. They need to be paying their landlords the money that is owed in rent. So don't think that home prices are the only thing to look at when it comes to measuring the economy. There's actually a lot going on beneath the surface that isn't being talked about that could have a significant impact for investors. And that is particularly short-term rental operators. If people feel like they are not wealthy, they are not going to take as many vacations. If you're a short-term rental operator, looking at comps doesn't help you. It doesn't matter what a house used to bring in if people just stop traveling or they're looking for more budget-friendly options when they travel or they don't stay as long as they did. You can be a great operator, but you can never outwork the economy. So what are some of your thoughts there, Christian? I know that you're helping to approve a lot of the clients that we have at the One Brokerage, and you'll often notice, what is it you told me the other day that to buy a $500,000 house or so, how much money did somebody have to make?
Yeah, it's getting ludicrous. I mean, you got to make multiple hundreds of thousands a year nowadays in some of these high value markets, and maybe you get a household family of 2 people making $100K each, in LA or San Francisco or something. But like when that's the entry point, when that used to be like the high point, I remember when I was young, somebody made 6 figures. Oh my God, you make 6 figures. Like that was like a lifetime accomplishment. Now it's like that's poverty level in some of these high value areas. It's like you got to do that to pay for your gas, And I just want to share I feel like there's a little gold nugget in this article as well. If you guys haven't checked out MBS Highway, check it out. They got some good stuff. There's some really interesting trends taking place. And I remember I said this, if you guys go way back, I think it was actually my first appearance on the BP podcast, David. I kind of said that in the next 3 to 5 months, I think if somebody doesn't start buying property now, I'm not sure you'll be able to. And here's some simple numbers. First-time home buyers accounted for 27% of sales, down from 35% 6 months ago. 35 to 27, that's an 8% drop in first-time home buyers over 6 months. Cash buyers accounted for 29, up from 23, and investors made made up 18% of transactions, up from 15%. So who's buying houses now? All of the percentages are favoring people who already have houses. So these are people utilizing leverage. They're people utilizing HELOCs. It's not that the gross ability, obviously interest rates and purchase prices make it difficult for first-time home buyers, but the people who are taking advantage and getting into real estate are scaling quicker because the real estate is going up with them, right? It's the rising tide argument, right? It's allowing these people to keep their boat above water, right? Whereas somebody who may be holding off or, this isn't pressure sales, this is just telling you what the facts are with the numbers that are posted. Real estate is consolidating into fewer and fewer hands. That's exactly what this means. First-time home buyers are down, seasoned investors are up. That means more people in a certain, category are buying more real estate. And I think this will continue in this trend, right? Because as the prices continue going up and rates keep going up, it's the only people who can accomplish homeownership.
And I think that it's easy to make the mistake of assuming that everybody in the world is in the same boat that you might be in. So somebody's looking at housing and they're saying, this is unaffordable, I can't pay it, prices have to come down. But it's unaffordable for you because you're using Fannie Mae or Freddie Mac financing and your wages are not going up with the economy. They might even be getting squeezed as your wages stay the same, but the cost of your living is going up. The food that you're trying to eat, the energy you have to pay for, your own housing, you're making less money and having to buy real estate that's less affordable. But your competition, hedge funds out there, companies like BlackRock and other institutional funds, they can borrow at less than you can because the more money that you borrow, the lower the interest rates tend to go. And they don't have the same squeeze happening on their finances. When they're raising money from wealthy people, it doesn't matter what the cost of a tomato or a steak is. They're playing by different rules. And it's easy to assume that because you're struggling, everyone else must be struggling, so prices must come down. That isn't the case. If prices did come down, you would see more of these institutions scooping up the properties that traditionally the newer investors were able to go in there and get a foothold, grow an equity, and scale from there. So my advice here is you need to be working harder than ever to build that initial foothold. You need to be trying as hard as you can to make money and saving as much as you possibly can and investing the difference, and stop complaining that it's getting harder. I talk about this in my new book, Pillars of Wealth: How to Make, Save, and Invest Your Way to Financial Freedom. It focuses on 3 pillars: saving your money, making more money, and investing the difference instead of just one. Christian, if people want to follow you, they want to stay up to date with mortgage information outside of Mortgage Mondays, where's the best place to get a hold of you?
Yeah, best place, guys, social media, repost of all this content as well as more that we do at The One Broker on all social medias. And obviously our company, you guys know by now, The One Brokerage. You can visit our website, theonebrokers.com, for more information on what we do and how we help you get real estate.
There you go. And you can find me at davidgreen24.com, at davidgreen24 on your favorite social media. Instagram is the one I look at the most, or my YouTube is David Green Real Estate. Thank you for joining me here, Christian. Appreciate your support with this Mortgage Monday market update, or a moo, so to speak. Let us know in the comments what you thought of today's show and what you'd like to hear more of, and we will be back next Monday with another update.